Let me start with you, Mr. Rudin, on oil. It's all plus plus, isn't it? You've got to love cheap oil, right?
Well, obviously, we need oil to heat our buildings, and particularly in this very cold winter. And so I think, and for consumers, it's a very good, very good thing, and good for our operating expenses.
And also for construction as well. I mean, there's a lot of hydrocarbons into construction.
It goes right through the food chain of the cost of producing our products. So it will definitely be helpful. And we've had issues with construction costs over the past several years.
Jeff Curry, thank you so much for being with us from Zurich when you published your report on the new oil order. Has Saudi Arabia given you a response? Have you spoken to any of the major OPEC nations about your research work and how they would respond to your thesis?
Yeah, I've spoken to quite a few of them, and I think they really do get the point that, market share really is the key here. And I think that shale has fundamentally changed the way oil's produced. In fact, I like to joke it's turned oil into producing something like paperclips.
Why has shale in Pennsylvania changed oil production north of Riyadh?
Okay, when you look at the old days, there was a long time to build between when you would commit capital and when you would get production. It could be as high as 3 to 4 years. Shale has taken that time to build down to 28 days. So if I commit capital today, I can get production in 28 days.
I did not know that. Yeah. That's amazing.
And what that does is if OPEC or somebody cuts back production, make prices rise, the ability for shale producers to come back in there, increase production, and take market share is incredibly high.
Jeff, when we get comments now from OPEC, it feels like whistling past the graveyard. Is there a difference between what they say publicly about non-OPEC production, their predictions for the future, and then what they tell you privately about the way they think the new market looks?
No, I think where their focus is on the potential for demand growth. I think they do recognize that shale is now the dominant technology and is going to meet incremental supply growth going forward. So the real key for them when they think 3 to 5 years out is what's happening to demand.
I'm going to put this chart out on Bloomberg Radio Plus. It's one of my most famous charts. It's oil adjusted for price, for inflation, but also adjusted for rising disposable income. Jeff Curry, we're richer than we used to be in other oil crises. If we get your colleague Edward Morris's 20 a barrel, if we get Gary Schilling's $10 a barrel, what does that do to the global oil order?
Well, I think most of those numbers are one touches as opposed to thinking about some new longer-term equilibrium.
And Ed Morris will say that. It's one touch.
Yeah, and I think that the key there is where is the longer-term price?
Where is it?
Right now, we would put it at somewhere around 65, but with a lot of uncertainty. Currencies are moving, other commodities are moving. I've talked to metal companies who can't even do their budgets right now because they don't know where these moving parts are.
Will that 65, or if you migrate down to Ed Morris's $54 a barrel, does that change production for the major integrateds?
No, because what's going on here is it's a cost rebasement, and so when we think about the costs coming down, one way to put it, actually, I like to borrow a line from the ex-CEO of BP. When he was running BP, it was a 15% ROE business, whether the price of oil was 20 or the price of oil was 100.
Still make money.
Because the costs are coming down, and I think that's the real key message here.
Okay.
All right, Tom, I'm going to call an audible here. Right before we started, Bill Rudin passed me a Wall Street Journal with one number circled. That number is $33 billion is the amount of capital that U.S. venture firms raised last year. And I've been looking at this earlier this week. That's the most since 2000. What does that mean for your world?
Well, it means, it's reflective of our new economy and what's driving in terms of job growth, and particularly in New York City, which I'll talk about later. We've increased jobs nearly 100,000 this year, over 450,000
within the greater New York City area.
Over in New York City, and it's largely driven by technology. And we were talking before, it's also about capital. There's tremendous capital out there. People are investing in these companies. They're growing. I think 5 of the top 40 that were on the Wall Street Journal list are based in New York City, so that's great. And you're seeing that whole, again, it's cycling through the economy. These companies are innovators, changing the way they do business, and our city has to adapt to those type of potential buyers, renters, and users.
I mean, I got to be honest, I see an Apple there on your lapel, but what this number says to me, $33 billion in venture capital, is that the Rudin Group should start building towers in San Jose.
Well, no. Apple means New York City.
I know.
This is what it means and symbolizes. And we're building in New York City because the demand is here for the type of businesses that we think are growing. They're the Ubers, they're the the Facebooks, they're all, and companies all across the technology spectrum are expanding here in New York.
Within this good feeling about money, I go back, Jeff Curry, to the collapse of oil. This has to be a massive opportunity in mergers, in combinations, in transactions for the strong in the oil business. Who are those people?
I think there lies the problem with the oil market right now, which is why we argue lower for longer, and we see the market trading in these low 40s for quite some time because there's too many tourists in this market, too much capital. In fact, we actually came up with a number recently that private equity money alone is nearly $50 billion sitting on the sidelines. That's a lot of capital. Also, in the last 10 days with the rise in prices, we've seen 7 equity issuance and 1 high-yield debt issuance, which tells you when these prices get these higher levels, too much capital is coming in the market. So we argue prices got to get low enough, long enough to discourage this capital from coming in. And now, to answer your question, who are going to be the winners and who are going to be the losers here? One thing that's very interesting about this market right now is that when you look at the U.S. assets, those are the high-quality assets. They're typically held by the weaker balance sheets. When you look at the international oil companies, they have the lower quality assets but the higher quality balance sheets. So what we need to see over the next 12 to 24 months is a shifting of the high-quality assets going to the high-quality balance sheets and then the low-quality assets disappearing.
If it's about short lead time and market share right now, are we going to see other shale regions come online just to grab market share, the UK, Poland?
They're not large enough. The key ones we're watching are Mexico and Argentina, potentially Russia if the sanctions get lifted.
Okay, Jeff Curry with us with Goldman Sachs and Bill Rudin on the spirit of New York City real estate. It looks like Dubai. There's cranes everywhere you look.